Good afternoon and welcome to Nasdaq Trade Talks. I'm your host, Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me for a market update, we have Chris Dearborn. He's the Managing Director on Nasdaq's Markets Intelligence Desk. Chris, great to have you join me on a Tuesday afternoon, kind of switching it up a little bit here. And the reason I want to do this is the tone for January and for this week seems to have been improved a little bit if you're a bull. Clearly risk factors out there, but it seems to be today investors are optimistic on potential trade deal.
Absolutely. You can actually walk this back a little bit to Friday that leads into today, right? So when we spoke last on Friday, you had Fed Chairman Powell's comments that really sent a huge shot to the bulls. It really gave them that shot in the arm. You saw a risk-on environment. You saw shorts covering. You saw the Nasdaq Composite close up over 4%, and all the other major indexes closed up 3.5% plus. Right? So that's one of the trifectas that we have going on here. The second part of the trifecta was the non-farm payroll number that we talked about, a very robust number. You saw year-over-year wage growth increase with that, and demand is still out there for the U.S. worker, which is still at a very low unemployment level, which means that people can demand higher wages if they can find the right work. And the third part of that right now is the Trump tariff conversation. So the budget kind of rolls into that, and we're in the third week of that budget shutdown. And with that, you have really a political tete-a-tete between the Republicans and the Democrats, really the White House and the Congress. And really, it's just an overhang. This too will pass, and the budget deal will get passed in one form or another. And whether or not what he says tonight, when he speaks to the country, is bullish, bearish, or goes off on a tangent, it's really irrelevant. The tone is that we have to get this budget done, and with that, you have to get the trade tariffs put into place. I think we're doing very well there, and that's the risk-on sentiment here right now. We made the S&P made a 52-week low back right at, around Christmas time. You had a closing low on Christmas Eve. Granted, it was a short day, but an intraday low the following on the 26th. And he's had very high trading volumes throughout the entire month of December and coming into January, well above the average. Right. So for the year, we've been averaging 7.2 billion shares a day in the consolidated tape. For the entire month of December into now, excluding the half day of Christmas Eve, we've been averaging over 8.3 billion shares a day. That is telling you that the volume is there. Look at the VIX, you're still trading with a 20 handle.
That's almost 2.5 billion more than average, right?
Especially over a holiday week. And what you have there is people are uncertain. We're looking for clarity. And that's where this all ties in together. So how do you tie it together? Right now, you've got two of the chess pieces in place. And what you're looking at right now is what is guidance going to be? Companies have been guiding down for the entire year, coming into the earnings season, coming up right here, and people are cautious. Investors are cautious. They were writing down assets at the end of last year. You saw major tax selling implications, especially as the index is sold off to negative territory. And with that, the hedge funds, one of the major near-term investors, on average lost about 2% for 2018. So what you're looking at is people have a low watermark now. So if you are in an oversold condition, as we seem to be right here and now, and if you look at the S&P 500, that 2550-ish level where we are right now, which is a 50% Fibonacci retracement from the 52-week lows made right after Christmas to the 52-week highs that we made in the beginning, at the end of Q3 and beginning of Q4, we're right at that inflection point. So we need something that technical traders always say, and I, as a former trader, believe it, good fundamentals make good technicals.
Right, I'll agree with you there.
Yep, and right now we're looking for that good fundamental. Will the tariffs agreement, which seems to be on track for that March deadline, be put into place and be enough for a lot of the corporates to start to lift their guidance for the forecast for the rest of 2019, and that's the catalyst we're looking for right now.
And if you look at stocks at the levels where they are right now, guidance wasn't particularly that great because there's so much uncertainty out there. If we get a trade deal that's satisfactory for both sides, if we can get these government shutdown resolved, which in my mind, I think that's an issue to me. You have over nearly 1 million people, and you will start to see departments in the cabinet also not get their paychecks, which will put you over that million threshold. But it trickles down everywhere. If you're not getting paid, your babysitter's not getting paid, your waiters and waitresses in restaurants aren't getting paid. It trickles down, and that has a significant impact on what has been a bright spot in this economy, which is the consumer. That's a big concern. That's 2/3 of our GDP, and we're really relying on a strong economy, a strong consumer. So if we get a satisfactory deal on the China trade war side, if we get the government back to work, a long-term sustainable solution, earnings, I mean, you have a baseline which is, so low. and where stocks are right now, this has to be, in one way or another, a value manager's dream if these things fall into line with a dovish Fed.
Correct. So the dovish Fed was the key part, right? He talked back what was said, and we got a little bit more Fed speak this week to see how they validate. But also remember, if the economic conditions change, so we're definitely data dependent, right? And it's always been said that. So is the FOMC also market dependent? And that's been the big argument recently. And the question is, they've always had an eye on the market.
Right.
Going back to Greenspan and everybody else. But did they act on it? No, not always. So now you see a more reactive Fed. Now, you're looking at Bostic the other day saying, maybe we're going to do one rate hike this year. We're saying maybe 0 rate hikes. The Fed fund futures have more of a chance of a rate cut for 2019 than a rate hike. So we're kind of in this area of flux. Either way, that's a good as bad scenario. The economic data is telling us that the scenario is still good.
Right.
So therefore, good is bad. And if they raise the rates again once or twice this year, that could be a wall to this market moving higher.
Right.
Remember, the tariffs are kind of self-inflicted, if you will, here in the U.S. And with that, we're looking for a better government deal for all. And if it does come to fruition, Trump has taken it on head on, good, bad, or indifferent. This is what he's doing. And if it works out, it could be very, very good.
He'll own it if it works out.
It will. And what will happen there is that the companies will reap those benefits, which means that investors will reap those profits as they trickle down to the bottom line from the top line.
Right.
And you have to work through that cycle, but it'll be there. So that's what we're looking for right now. If that happens, this could be a bonanza for investors for 2019.
Right. Even Jamie Dimon, CEO of JP Morgan Chase, he told Fox News, I think we are going to have decent growth in 2019 in America. Guy's way smarter than I am, so if he's positive on it, I think that's, he's also a banker, so I would imagine that's something that he likes to see. But I think once we get through those hurdles, it could potentially be a nice setup here for stocks on the long side. But again, we do have to recognize that these risks are out there, hence the VIX at 20.
Right. A 20 VIX, higher trading volumes is showing that volatility is still into the market. And once that VIX starts to settle down, the volumes start to decrease a little bit towards that 52-week average that we saw last year and the year before, where the markets saw higher highs month over month since the presidential election. That'll tell you that we've come into a more stabilized investing environment. And that'll take money that's on the sidelines, especially from the long onlys, back into the market and start to push us a little bit higher, putting that underlying bid for a lot of those companies that have been beaten up significantly.
All right, come on, Nasdaq 10,000. Chris, thank you as always for joining me. And thank you for joining me throughout the week. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.